Right, business owner, real estate investors. So, what are the highest risk industries in obtaining business loans? Well, in the last video, I talked about the lowest risk industries. Now I'm talking about the highest risk industries. So, when it comes to obtaining business loans, some industries are generally considered higher risk by lenders. These industries may face challenges in securing loans due to various factors. So let's explore them. And I'm going to cover seven. And what I want you to know and chat on the bottom is let me know what you think of these seven, right? If truly of these seven. So you'll say boo, yay, or whatever. So number one, restaurants and bars. Now, typically, the food industry is known for its very high failure rate. Restaurants and bars often struggle with slim profit margins, seasonality, and intense competition, as lenders may find these very risky borrowers. Well, I can say in my 20, going on 22 years of business, I helped a gentleman who was in IT. He wanted to start a restaurant. I helped fund the whole startup restaurant venture for him. Unfortunately, because he wasn't as well versed in that industry, the restaurant industry, unfortunately, that business folded. So I have financed other restaurants that done beautifully, but I'm just saying it's can be very challenging. Number two, the construction industry. Actually, that's an industry that I came out of and going into finance, having to struggle looking for funding for my contracting business. But construction companies usually deal with project-based revenue and then labor costs and market fluctuations, and can be really affected by economic downturns that can significantly impact the construction industry and businesses and making them just riskier for lenders. What do you guys think about that? I will say there are some specialty lenders for construction based on that. There's like mobilization capital and project-based funding, that kind of stuff for the construction industry. Number three, real estate development. So I love this industry, but real estate development involves substantial capital investment and long project timelines and market volatility. So I was working with a developer out of Texas, and it just, you know, he invested a lot of money and certain things got stalled. Well, actually, another one in South Carolina, things stalled and they found some challenges that needed more capital investment. And so just look at it. You're building something from the ground up, right? This is not something that's stabilized, already bringing in revenue, income. It's pretty risky. Real estate development can be very risky. Um, Startups is number four, and I'm talking about as a whole. So newer businesses basically just lack an established track record, making it very challenging to assess the credit worthiness, right? So if you don't have any financials, uh, how can a lender kind of bank on that, right? So startups often face uncertainty and financial instability, which lenders just find challenging when evaluating those for loan application. That's why most startups are funded by SBA loans. You know, you go to a traditional bank or financial institution, what they're going to say, they want to wait until you have 2 or 3 years of business history before they consider funding you. So, well, there you go. So number five, online retail. Now, while e-commerce has grown rapidly, um, recently online retailers have just faced a lot of competition. I mean, they were doing gangbusters during the pandemic, but But with the competition, just customers just changing their preferences on what they want, one year this thing could be great, the next year it can't be great. And just the logistical challenges, just getting manufacturers to deliver stuff on time and that kind of stuff can these factors contribute to their high risk profile, especially as of late. All right, so number six. So we're doing seven, right? Transportation. So companies in the transportation industry, such as trucking, they deal with fuel costs, just regulatory challenges, just economic cycles, and a lot of these uncertainties make them riskier for lenders. And there's lenders that focus solely on transportation industry, working with companies with their way bills and that kind of stuff in order to make sure that they're liquid. And I've worked for a lot of trucking industries, financing brand new trucks, that kind of stuff. It can be challenging. Uh, Number seven, fitness and wellness. Okay, so gyms and fitness centers and wellness studios operate in a very competitive market. Their revenue can be affected by seasonality, membership fluctuations, and just shifts in just the health trends in the marketplace, right? Well, as I'm taping this, we're in March, and let's look at uh January, right? January is probably when people joined up in the gym for and drove for their, New Year's resolutions. How many of those people are still going or going on a consistent basis? Probably not as much, right? So that's one of the challenges. Now, I will say, what do you think about this list? All seven. Now, remember, each lender has its own criteria, right? And risk assessment varies from lender to lender. Now, while these industries are generally considered high risk, individual circumstances matter, of course. Business owners should present a strong case if you're one of those to alternative financing options if those traditional lenders are very hesitant to lend to you, right? So what do you think on this list? But join our Keys for Business Masterclass where we talk about how to get access to capital without taking out a loan, putting up your business for equity like going on Shark Tank, or putting up assets like your personal home in order to get access to funding. So go to keysforbusiness.com/masterclass for more information on that. All right, yeah. Let me know what you think about that seven list.